Have you checked your investments lately and felt a little uncomfortable? Maybe your investment statements just does not look as exciting as they did about a year ago. Most people see an investment turn down and think they've actually lost money. But what if I told you that periods like this can actually help you generate more wealth? Today, I'm going to explain to you why temporary turndowns in investments can be the biggest opportunities for future growth. When markets are rising, investments feel easy. You open your statement, you see growth, and you feel comfortable, you feel at ease. But when markets decline even slightly, you feel emotional, and your emotions take over. News headlines become negative. People start wondering if they should rather stick to cash or move all their assets to cash investments. Some investors even stop their contributions or stop contributing overall into all their investment portfolios. The challenge is our brains are wired to avoid pain. Losing money is painful. When we see our investment balance fall, it feels like something's wrong. But if you are a long-term investor, temporary downturns is definitely not necessarily a bad thing. In fact, these are the golden opportunities that most people usually miss. Think about it this way. If your favorite retail outlet has a 30% discount sale, you don't get panicked, you get excited because now you can get more items for the same value of money that you budgeted to spend there. Yet, when your investment goes on sale, people panic. Let me put that into a simple example. Imagine you invest 2,000 Rand a month into a diversified investment portfolio. In 1 month, the fund price is 100 Rand per unit. Your monthly 2,000 Rand buys you 20 units. A few months later, markets are under pressure and the unit price drops to 80 Rand per unit. Now, your same 2,000 Rand actually buys you 25 units, not 20 units. You're not investing more money, you're simply getting more units for the same 2,000 Rand contribution. And over time, when the markets start performing again, those extra units is what generates your long-term wealth. For most South Africans, investing isn't necessarily about picking individual shares. It's about investing in certain retirement and investment products. So when markets are weak, you feel like your investments may be temporarily losing value, and that can feel discouraging. But if you continue to contribute every month, you are really just buying more units with your same contribution. I've said it before, and you're going to hear it from me a million more times. Time in the market is everything. The biggest risk during a market downturn is not the downturn itself. It's the reactions of the investors when that downturn happens. If you go hide out in cash instruments every time you get emotionally panicked over market downturns, you're missing out on the upswing when that happens. And the problem is, or the opportunity, depending on how you look at it, is that nobody consistently knows when a downturn is going to start or end, when an upswing is going to happen. Some of the strongest market gains happened after short-term downturns. Look at COVID, for example. April 2020 is a period where every single asset class actually took a dip. But the upward swing when we went through that dip was phenomenal. So if back then, for example, you were sitting on the sidelines waiting for things to get better before actually investing your money, you lost out on tremendous growth because you can't time the markets. Let's imagine two investors. Investor A contributes 2,000 Rand a month and continues with the contributions even through the market difficulties. Investor B contributes the same 2,000 Rand a month but holds back on contributions every time the market goes through a dip or a downturn. 5 years later, Investor A has accumulated significantly more amounts of units because they kept investing and contributing even during the downturn. Investor B avoided short-term discomforts but missed out on buying a lot of investment units at a discounted price. You'll never align those two investments in value again without substantial additional contributions from investor B. The difference is not necessarily about investment skill, it's about consistency. When you invest, you're not buying today's market performance, you're buying years of future growth. Over time, patient investors get the most rewards. And this is why successful investors do not look at 1 month's performance to determine the value of an investment. Successful investors focus on where they want to be 10 years, 5 years, 20 years, 80 years from now. So next time your investment statement looks a little disappointing, remember this: a downturn does not mean you're moving backwards. If you're focused on long-term goals, downturns may actually be helping you accumulate that growth for your future faster. The goal is not to avoid a decline. The goal is to power through them, because sometimes the periods that feel the most uncomfortable are actually the periods within which you accumulate the biggest long-term growth. If you found this helpful, give the video a like and subscribe for more advice insights. Let me know in the comments. When markets turn down, are you the type of investor that keeps investing, or do you prefer to sit out and wait on the sidelines for things to get better? Thanks for watching, and I'll see you in the next video.